You know, the Indian financial landscape keeps shifting, and one thing that's really stood out recently is this government plan. They're looking to list, I think, at least 5 regional rural banks, RRBs, by the end of FY27.
That's right. A significant move.
So our deep dive today is really about, well, why now? What does this actually mean for these banks? And maybe even for you listening, we're looking at this through the lens of a recent news piece.
And it's worth remembering the context, right? The
Yep.
whole one state, one RRB policy wasn't that long ago.
Ah, yes, the consolidation.
Exactly. That was all about improving efficiency, streamlining things, and cutting down on overlap between the sponsoring public sector banks. Now we're down to 28 RRBs.
28 covering what, 26 states and a couple of UTs.
Correct. And their reach is massive, over 22,000 branches across 700 districts. So this listing plan, it feels like the next logical step in their evolution, perhaps.
Okay, so let's unpack the why. Why this push for listing? The government seems to be talking about boosting their reputation, making them seem more credible.
Credible, valuable, yes,
Yeah.
for stakeholders, for investors. And the idea is that going public, well, it brings more scrutiny, public accountability.
Which hopefully leads to better operations and, I assume, more funding. Is it mainly about the money?
The funding is definitely a huge part of it. I saw a quote from Krishnan Subramaniam, a former MD and CEO in the sector.
Oh, yeah. What did he say?
He basically argued these IPOs are potentially crucial, vital, even for the long-term survival of our RBs.
Vital. Wow.
Yeah. Because of that public accountability piece,
Yeah.
plus the ability to tap into the market for funds, it lets them operate more professionally, potentially scale up.
Okay, that makes a lot of sense. But it's not like any RRB can just decide to list, right? There must be criteria. The article mentioned draft guidelines from 2022.
Yes, and they're quite specific. For starters, a minimum net worth requirement,
Which was?
300 crore. And not just once, but consistently for the preceding 3 financial years.
Okay, 300 crore for 3 years. What does that signal?
Scale.
Yeah.
Stability. Both, really. It suggests the bank has a solid capital base, enough to handle market ups and downs and, invest in growth. Doing it for 3 years shows it's not just a one-off good year. It shows sustained financial health.
Got it. And there was more than just net worth. Capital adequacy ratio, too, above 9% for 3 years. Why that specific measure?
So the capital adequacy ratio, or CAR, it's like a bank's financial cushion. It's safety net.
Right.
It measures the bank's capital against its risk-weighted assets. Being above the regulatory minimum 9% here means it has enough capital to absorb potential loan losses or other shocks, protects depositors.
And doing that consistently shows they're managing risk properly.
Precisely. It demonstrates a disciplined approach over time.
Then there were profitability metrics, something about operating profit.
Yeah, operating profit before tax needed to be at least 15 crore, but not every year in 3 out of the last 5 years.
Okay. And ROE and ROA, too, return on equity and return on assets.
That's right. ROE of 10% and ROA of 0.5%, again, in 3 out of the preceding 5 years.
What do those tell an investor?
Well, ROE shows how well the bank is using shareholder money to generate profit. ROA shows how efficiently it's using its assets overall. Meeting these targets suggests the bank isn't just stable, it can actually generate returns, deliver value.
And one last thing, they can't be under the RBI's prompt corrective action, the PCA framework. That sounds like a deal breaker.
Oh, absolutely. PCA means the RBI has flagged significant weaknesses. You can't really go asking the public for money if the regulator thinks you're already on shaky ground. You need a clean bill of health.
Right. Makes sense. So looking bigger picture, all that earlier consolidation, the one state, one RRB stuff, seems to be setting the stage. There was a PwC India report mentioned.
Yes, projecting quite significant growth. They estimated the total RRB business, as a slice of India's GDP, could reach around 5.2% by FY30.
Wow, up from about 3.7% in FY24. That's quite a jump.
It really is, and it highlights just how important these RRBs are becoming, especially given their focus, their orientation towards rural areas. That's still their core mandate.
And their unique capital structure reflects that, doesn't it? With the central government, state governments, and the sponsor banks all chipping in.
Exactly. It's built for that rural focus.
Okay, so let's try and sum this up. We've got the government wanting to list RRBs for better reputation, more accountability, and easier access to funds.
Check.
And for an RRB to even be considered, it needs to hit some pretty demanding financial targets, consistently net worth, capital adequacy, profitability.
And be in the regulator's good books, yep.
And all this builds on the consolidation efforts, with projections showing these banks playing an even bigger role in the economy, particularly in rural India.
You've got it. This isn't just a niche financial story. It connects directly to financial inclusion and grassroots economic development because of where these RRBs operate.
It really does. Which, leaves you with a final thought. As these RRBs potentially step onto the public stage, what kind of new opportunities, but maybe also new pressures or challenges will that create, both for the banks themselves and, crucially, for the rural communities they were set up to serve? Something to keep an eye on.
Definitely something to watch.